All right, for more on today's action, let's bring in Rebecca Patterson, a former chief investment strategist at Bridgewater Associates. Rebecca, always great to get your take, especially on a day like today. What's your take? Has anything fundamentally changed about the markets?
I think today is fundamental and technical, but I would lean on the technical. Whether you're invested only in U.S. stocks and bonds, you have to remember we're in a global economy, global markets. And I do think what's going on with the unwind of the yen carry trade, people borrowing yen to buy higher yielding assets, and as people lost money on those trades, they needed to take profits elsewhere to manage their books. And so I think that was a catalyst that has affected a range of assets around the world, including U.S. equities. So I think that's part of it. We've talked about some of the other things, what's going on with tech, with regulators, with earnings, with rollouts, certainly with the consumer. We saw that in earnings. We've seen that in consumer confidence data, especially at the lower end. And then, of course, the job market. And as you all said, one payroll, I mean, it would be ridiculous to over-index to one number. Payrolls get revised regularly, sometimes by a lot. It's one data point. But I think we now have enough data points to feel confident the U.S. economy is cooling. But cooling doesn't mean a hard landing or recession or an intermeeting Fed cut, by goodness sakes. It just means we're cooling. So what I'm watching now is, are the technicals going to get bad enough and last long enough that they could start to infect, if you will, the underlying economy? Then it becomes fundamental. But certainly right now, we're not there. And we saw that in the service sector confidence survey today, which was actually better than expected.
Rebecca, the one thing that's held up reasonably well is credit. It has not been, nobody's talking about a credit event yet. Should we be worried about one, given all the things that have been taking place?
I mean, this hasn't been a credit-driven expansion. It's been an income-driven expansion. So we don't have a lot of leverage among households, which is really good news, actually. So I don't think we have to worry about that side of the equation. And in terms of corporate credit, while you have seen some borrowing, it looks nothing like what we saw leading up to 2008. So again, I don't worry about the leverage in that sense in the economy this time around. We know there's leverage in the system. We know there's overhangs of debt. The biggest one, obviously, is with the U.S. government. But in terms of having a repeat of 07, 08 dynamic because of household and corporate leverage, I don't think this looks like that.
Hey, Rebecca, it's Tim. So it is great to have your global perspective. And I was just going to go back to then the great safety trade in U.S. debt. Some might argue that, hey, at 375, there's still a lot to do, even though we've had a move from 480 down to 370 in a year's time. A lot of it's technical as well. A lot of this is unwind to carry trade. So just help us understand what this move in treasuries has meant. It's been so violent and it feels overdone, especially in the context of what you're talking about the economy.
Yeah, in the very short run, the move in treasuries to me does feel probably a bit overdone. So it really depends on your time frame. If you're a shorter term trader, if you're, then I think it might make sense to take some profit on those positions. But if you're medium or long term and you're thinking about diversification, I would just hang on. I think today you're reflecting on it. You've had a couple good lessons, and one of them is on diversification. You have so many investors out there saying you need geographic diversification. And I think it's helpful at the margin, but we're seeing today it's no panacea. Everything's correlating. Everything's moving together around the world. You need diversification across asset classes and sub-asset classes, types of companies, even your liquidity profile. You don't want everything long-term. You want some short-term. So to me, things like treasuries and gold, which I have liked for some time now, I'm taking a medium, longer-term view, and I would be holding on to both. Short-term, though, I agree with you. I think this has been a big move, and it's probably, unless we get some new bad news in the short term, it's hard to see it going a lot lower from here. A lot's priced in.
So, Rebecca, what you said, it doesn't look like 07, 08, and there could be a host of reasons why the sell-off happened. What is the tell from your perspective when the yen carry trade is coming to the end? What's the tell that you look for? If there is one?
No, it's a great question, because when you do have these technical sell-offs, and Melissa said it earlier, they're finite. And when you start thinking you're close to the end, that's when you want to start getting back into the market, but not the beginning of it. And I think we might still be at the beginning. Lori mentioned earlier the CFTC data. You can get currency positions in that. It's somewhat lagged. It's not perfect data, but that's one thing to look at. The other thing to look at for people who have access to it is going to be what the big investment banks that have large foreign exchange trading desks are saying about what they're seeing. And I believe there is some news on that out on Bloomberg this afternoon, for example, with one desk saying they're expecting some of the systematic traders who are basing some of their positions on volatility to have to unwind further. So this thing could go at least a few more days. So I'm looking for color from trading desks. That would be probably the most timely thing to watch. And that's just going to be their color. It's not going to be scientific, but I think it'll give us a sense where we are in that journey. Are we at the beginning, the middle, at the end? Right now, it's hard to say, but I would guess we're still close to the beginning.